All right. So yesterday we started out with looking at HPLR. Today we'll just try to wrap it up by giving you suggested exit points. It is expected that you go backtest this and play around with it a little and get your own exit points. But I'm going to give you my own exit points and how to run this. So we typically have Asia range, and then sometimes we have yesterday high here. Sometimes yesterday high can coincide, sometimes yesterday high can be inside, right? But let's use, this is textbook style. So you want to go into a trade, what you are anticipating is that price plays like this during Asia, then goes, take out Asia high, comes back, gives you a retest, and then you look for a reason to sell. That's what you're looking out for, right? There's an indicator called the ATR that we use in the Heroes group, and I'm going to introduce you guys to that. So if you're on MT4, whether mobile, whether desktop, you come to insert, go to indicators, oscillators, and you look for ATR, average true range, and you add that to your chart. It's by default at 14, right? You can add that to your chart. Once you add that to your chart, you come to your data window, right? Data window, and click on it. Your data window will give you this pop-up, right? So once you open your ATR, if you are somewhere like me that likes very, you like large room on your chart, you can practically minimize this, just minimize it, right? So you can get some room on your chart. So let's say I'm taking a sell off of this. This is a sell, right? I'm going to put my cursor on this candle. Now I want your eyes to come here. That's the ATR, right? It changes for every candle. It changes for every candle. The ATR on this candle is 11 pips. It's 0.1129. Now I'm not going to assume you understand what I'm saying. I'm going to explain it, right? If you are looking at a pip for non-JPY pairs, something like, let's say, GU, right? It's going to be 0.0001, or let me put it this way. A pip is going to be, 0.00123, something like that, right? So if you are counting a pip for non-Forex pairs, non-JPY, this is your pip. You start counting from this number. So this is going to be 1 pip, meaning that if I have 0.1125, this is going to be 1,125 pips, right? I hope we get that. So if we have something like 1.3251, and the next one is 1.3250, and they're asking what's the difference is going to be 1 pip. This for GBP. However, if you look at a JPY pair, right, the pip is 0.01234. Basically, this is your pip, right? That is your pip for JPY. So if you see 0.1125 for JPY, you're actually talking about 11 pips. So it's the second digit after the point, right? So let's have that at the back of our mind. So if I take my cursor now to this candle, it's showing me 0.1129. That is 11 pips. That's 11 pips. It simply means when I'm taking my sell, my stop loss is going to be 11 pips away from that high. So traditionally, how I do it when I'm backtesting is that I put my fib, and this is showing me 14 pips, right? So I'm going to add 11 to 14, and it's going to become what? 25, right? So that'll be 25 pips. My stop loss is going to be somewhere there, right? And you're taking a sell. So this hits your TP1, push back up, came back for your TP2, push back, and eventually hit your TP3 here, or even your TP4 here, right? You see that it took 2 days, but no problem. It got to your destination, right? So that is one thing you need to know. We mentioned that for a strategy, aside location, you must have a way of getting out, right? There must be a way of getting out, right? Getting in and getting out is important, and that's what we're trying to establish here. So this is yesterday's high. Our stop loss, we technically be somewhere there, right? Where the distance between these is your ATR, right? So here you have your ATR. Now, your TP traditionally should be between 1 to 3 pips if you are using, 1 to 3 R traditionally. However, there are some pairs and there are some things I see in the chart that might make me want to go for as far as 5, 10 R even, right? How huge, how the size of the stop loss matters for me. And I traditionally also look at the H4 when I'm trading this strategy. Remember, my bias is on the H4. If the next zone is far off, let's say I enter a trade from here now, right? The high before this low is this point. So that is going to be my first area of harvesting. So I will still take my TP1, my TP2, and anything I want to take based on my trade plan. But if this zone is still here, I can break even at some point, ensuring that I'm no longer losing, and wait to see if price will create a new high. By the way, if you remember, what price does is it creates a high, comes back. If it's going to be an uptrend, it must break this high, right? Then may come back again, and then like that. It's going to be an uptrend, it must break this high. This is the high I can see. I can wait for this point, but I won't just wait blindly, because several times price will do this. If you're waiting for it to come here, you lose this trade. So you must take something out. You must take something out, right? Now there's a nugget we use in the Heroes group. I'll be giving it for free here. One of the methodology we used, and it was Prof that introduced it to us. What we do is that we do what we call twin trade. We twin trade. And by twin trading, we mean we take 2 positions. So let's say I'm supposed to risk, unfortunately, in our schedule for this back to school, we aren't discussing risk management. We discuss risk management psychology. We are not going to discuss risk management mathematics. That is the mathematics behind risk management, the position size calculator, how to determine that, well, and all of that. We won't discuss it. We'll leave that for the inner caucus. But what we do is that we swing trade. So let's say you decide to risk. Let's say you have an account of $1,000. That's what you have. You have an account of $1,000, and you've told yourself that you're going to risk 1% per trade, right? 1% per trade will put you at $10. So if you're taking this trade and this is your entry, it means if price pushes up and takes out your stop loss here, you would have lost $10. So what we do is that rather than take only one trade and just look for $10, we divide that trade into 2. So we have trade A and trade B. Trade A and trade B, the lot size is such that it's equal, So let's say if I were to take one trade and target stop loss, my lot size would have been 0.5 lots. For instance, if my lot size was supposed to be 0.5, I'll then divide the lots to be 0.25 for A and 0.25 for B. You see, if the trades go and hit the stop loss, I still will just lose $10. Then I take the trade. But when I'm taking the trade, I have here TP1, TP2, TP3. So the TP stop, both of them have the same stop loss, right? The TP for A will be TP1. So when A moves to TP1 and B moves to, of course, they move together, they'll be at TP1. I would have made $10 on paper. I would have made, so let's put on paper and harvested, right? On paper, at TP1, I would have made $10 on paper, right? Because again, if they go to the stop loss, I lose $10. Now they are both at TP1. And remember, for all our strategies, TP1 to 2, 3 up till this level, based on this strategy, is usually equidistant. So I would have made $10 on paper, but I will only harvest $5 because now trade A will close. Trade A will close and trade B will still be running on $5 profit. If B moves to TP2, we would, on paper, have $10 here, right? Or $15 in total, having harvested $5. But we have only harvested still $5. When it moves to this point, it will hit TP. So on paper, we'll have $20, and then we would have harvested $20 too, right? So distance from this point to this point is $5 for each of them. B, $5, $5, $5, A, only $5. So A will close with $5 and go home. B goes for $15 more. So in total, we have made $2. So our risk to reward ratio, risk is 10, reward is 20. Our risk is 1:2. An asymmetric risk reward ratio is 1:2. Now, what happens if A gets to TP1 and we harvest $5, but rather than B comes this way and then goes back all the way to hit stop loss? Now I need an answer to this question from those who are new to SimplyPips. If you are new to SimplyPips, new, by the way, means that you joined us around June last year up till now. If you are new to SimplyPips, if A hits TP1, then B goes all the way back to his stop loss. How much have you made? Put your answer in the chat box, ladies and gentlemen. Put your answer in the chat box. Right? Aru may say $5. Yeah, I need more answers, guys. The priest said we lost $5. Joy said $5. Yes, put your answer in the chat box, guys. Put your answer in the chat box. These exercises are good. Sometimes we just talk and assume everybody understands. I need 2 more answers, guys. What will be? All right. Now I want Mustafa. Mustafa, are you a new person? I know that name very well. All right. So the correct answer is that you break even. You break even. Break. And that means you also lose $5. So you made $5, you lost $5. you go back home happy. You didn't really lose anything. So those of you saying you made $5 or you lost $5, your answer is wrong. And I hope you get that, right? So you have A and B, right? The risk on A, if you hit stop loss, is $5. The risk on B, if you hit stop loss, is $5. Total giving you $10. This is your stop loss. Then you have TP1, TP2, TP3. 1, 2, 3. A gets to TP1, $5. B gets to TP1, $5. At TP1, you also have $10, but you cashed out only $5, and you left this in the market. If it goes all the way to TP3, it would have given you extra $5 and $5. That makes it $15. And now you'll be cashing out $15 plus $5. That means you cashed out a total of $20. But if you cash out only A and B comes back to its stop loss, you also lose $5 from B. And now $5 minus $5 give you 0, right? That is the suggested exit point. And by exit point, I mean it's either you're exiting at stop loss or you're exiting at TP, right? Those are the suggested exit point for this strategy. However, for those of you who are more advanced, you could get more TPs. You could get more TPs depending on when you enter, and I won't be mentioning all of those in this webinar. Right, so let's go back to the example we shared here, right? Let's go back to 30 minutes. I think I drew one fib sometime, not, I drew a fib somewhere. All right, let's just use this. So here was the ATR 11. Okay, I think this was the one we did, 11. So I drew to 25. Right, see what happened here. We had the break, we had the retest after taking out Asia high and coincidentally yesterday high. Good one. And it started dropping, hit our TP1. Trade one we close. Trade one we close, and we'll harvest 0.5% of our risk. At this point, we are no longer afraid. Anything that wants to happen should happen. All we know is that we won't lose money. And if we lose, because again, I won't cover that part, Prof has covered it for the guys in the Heroes class. And if you lose, the worst you can lose is some cost for spread and maybe swap, right? But it's not going to be a massive loss that can wreak havoc to your account. So you hit your TP1, first trade, close, A closes. It plays around, comes back to entry, plays around, hit TP1 again, hit TP2. If you don't have a trade plan, once you hit TP2 and start pushing back, you exit. Most traders will cut the trade here. Some will even cut it here. If you stick to the trade plan, it moved, it played around, and boom, it's your TP3. Now you harvest, you are 2% up. Let's say you are risking 1% per trade. You are 2% up. Now let's check the next day. Here is the next day. Let's say you also got a reason to buy, just for the purpose of this one. So you got a reason to buy. ATR here is 12. ATR here is 12. So this is 15 plus 12 will give us 27. So you have 27. This is the break to the downside. It came back, it picked you, played around, and hit your stop loss. Here you lose 1% outright. But remember, you made 2% here. So you are still 1% up, right? We never claim we will never lose. Even though in real life, we will not have been selling this pair, we would have been buying. The Heroes class met yesterday, and we saw how we would have passed multiple accounts if we do this. This was our buy trade in the Heroes group. So let me just simply mark it up the way it's supposed to be. And I'll show you guys why we would have bought, even though we'll not cover it in this webinar. So here we are. This distance here is 13. This is ATR here is 16. 16, this is 31 pips, or 30 pips plus 16 gives us 46 pips. So if we go to 46 pips, Boom, he hit TP1, came back, and then hit all our TP. This is why we would have been buying. This date here is 15th of March. When we come here, this has been telling us to buy. In fact, we have something we call the C5 that helps us monitor 10 pairs. So we don't go to the pairs individually. We sit down on one pair, on one chart, and it tells us what's going to happen in 10 pairs, right? We sit down on one chart. This chart told us that we should start buying from the 10th of March. It has told us that we should buy 10 pairs, right? And what are the 10 pairs it told us to buy? It told us to buy AJ. That's the buy. It told us to buy AUD/USD. That's the buy. It told us to buy Euro/USD. That's the buy. It told us to buy GBP/USD. That's the buy, right? Remember, I told us on the 10th, we had all this day to choose our buys, right? It told us to buy NZD/USD. That's the buy. It told us to buy AUD/JPY. We've done that. It told us to buy CHF/JPY. Guys, that's the buy. These are your entries yesterday for the buy. We took out Asia low and then we bought. It told us to buy Euro/JPY. That's the buy. It told us to buy GJ. That's the buy. It told us to buy NZD/JPY. That's the buy. And it told us to buy CAD/JPY. And I'm sure if I call it up, that will be a buy. We monitor it only by looking at one chart. If you've not passed through a fostering program, or you passed through it and you were sleeping, go back, watch the videos. So that is the exit point for HPLR. And I want to stop here at this point because we have another thing to cover, and we'll stop this recording and start a new one.